Welcome Bitcoin friends, it's Bitcoin Mamo. Today we're going to look at the Bitcoin charts and we're going to be comparing the three major cycles over Bitcoin's history. We'll be measuring the percentage gains from bear market low to the next bear market low, also the percentage gains from the halfening to the next bear market low, and the percentage gains between halfenings, and also the percentage losses from the bull market peaks to the bear market lows. And we'll be comparing those previous cycles with our current cycle to see where we're at and perhaps give us a better idea if we are in a bear market or a bull market. If that sounds interesting, stay tuned and let's get into the charts. So this is the whole history of the Bitcoin price. This is on the BLX chart, the Brave New Coin Index, and this goes all the way back to mid 2010. Bitcoin was created back here where I have this purple line. The earliest price data we have is from mid 2010. I do have these lines drawn on the chart. The green lines indicate each of the bull market tops, the red lines are the bear market bottoms, and the white lines are the halfening dates. So up first, we're going to compare the three cycles here, with the starting point being the bear market low and the end point being the next bear market low. The third cycle is still in progress until we can confirm a bear market low. So we'll look at its progression compared to the previous two cycles. And just showing you all three of those cycles side by side. This is the first cycle on the left from 2011 to 2015. The second cycle went from 2015 to 2018, and the final cycle, which started in 2018. So this is all three cycles now. They all start from 0% at their respective initial bear market low starting points. On the bottom here, we have the number of days, and on the vertical axis, we have the percentage gains. In yellow here is that 2011 to 2015 cycle. In red is the 2015 to 2018 cycle, and in the blue is our current cycle. So just looking at that first cycle here, obviously it did have bigger percentage gains. If you would have bought at the 2011 bear market low and sold at the 2015 bear market low, just for example, then that would still be a 8,600% profit, and that cycle did take 1,150 days. Looking at the next cycle in red, this is a 1,500% gain, and it took 1,430 days. And looking at our current cycle in blue, we are still currently up 1,070% from that bear market low, and it's currently taken 1,180 days. This is on the logarithmic scale here, so things may look closer together. On the linear scale, they are much wider apart. This is easier for comparison's sake. And just using the cycle between bear market lows here, we do see that the second cycle, the previous one, did take an extra 280 days to complete. And there is that theory of lengthening cycles. We only have a couple of cycles to compare here, but if we were to lengthen our current cycle, when looking at the distance between the first and the second cycle endpoints, then that would give us the bottom of the bear market after 1,710 days, which would be in another 530 days, which does seem like quite a long time. If we are sticking to the 4-year cycle hypothesis, and 4 years is 1,460 days. This second cycle took 1,430, so pretty much 4 years. And if we were to take a similar amount of time, that would mean that the bear market low will be in around 250 days, which would be sometime towards the end of November of this year. It is quite interesting here. If we look at our current cycle in blue, we were actually ahead of both cycles here early on. We remember we had that big run up from around 4,000 to 14,000, I think it was, almost a front run before the halfening date. And then we did have that big correction back down. We spent time around 10K, and then we had that stock market crash, pushed us back down to around 3,000 or 4,000. And then we did recover, and we were pretty much in line with the previous cycle here between the red and the blue lines. We did get ahead at the start of 2021. Then we spent time between 60 and 65k here. The previous cycle did catch up. And then, of course, we had that China mining ban and Elon's tweets. We had that 50% correction down to 30k. And the previous cycle did get ahead of us here. We did recover from 30k and go all the way back to 69k, forming a slightly higher high. But then we did distribute at the top and came back down to 35k. So a lot of people, including myself, were expecting a blow-off top here at the end of the bull run, quite similar to the previous cycle. But we did get more of a double top here and distribution around both of these tops. And we can see the peak was around here, and it was pretty much in line with the peak in the previous cycle when looking at the number of days from the bear market low. So if we are doing a similar 4-year cycle comparable to the previous one, we could be in a bear market already here, and we're doing a similar thing here with these dead cat bounces and coming back to a base before we do have eventually one more consolidation down, and perhaps 30 to 35k is that base, and we may get a few more dead cat bounces along the way here, and perhaps one more capitulation at the end, possibly to 20 or 25k. On the more bullish case here, we could compare our current cycle to the first cycle here, which did have this long consolidation in the middle of the cycle after a quick run up. And this consolidation did take around 200 days here mid-cycle, whereas with our current cycle, we have been in this range between 30 and 60k for around a year's time. But we would expect that if we are doing lengthening cycles, as each part from this first cycle would get lengthened. So this is on the log scale. If we were to switch to the linear scale, we will have to get rid of this first cycle because the gains were so high that it will just make these two cycles look like flat lines. So I have just included the red and the blue lines here, which is the current cycle in blue and the previous cycle in red. So we do get a better idea here when looking on the linear scale, how different these two cycles are playing out. We were all expecting a blow-off top, whether from this high here and a carry-on, or from the recovery back to 69k, and then a blow-off top. But because we didn't have that blow-off top, perhaps we could expect that the traditional percentage drop from the bull market peak to the bear market low won't be as severe. But again, if we are doing lengthening cycles and something similar to that first cycle, then we would expect this to go for a lot longer. So now we're going to compare the 3 cycles again, but we're changing the starting point to the halfening date and still going to the next bear market low. And just showing them side by side again, the white line is the halfening date, cycle 1 on the left, cycle 2 in the middle, and current cycle on the right. So all 3 cycles overlapped again, with the starting point from the halfening date instead of the bear market low. The first cycle is in yellow again, second cycle in red, and current cycle in blue. So just looking at the first cycle in yellow, going from 2012 to 2015, if you would have bought from the halfening date and held it all the way down from the peak to the bear market low, you still would have been up 1,340%. And this cycle took 776 days. The second cycle had a percentage gain of 400%, and that took 809 days. And the final cycle is still up 330% from the halfening, and we've been going for 664 days. So using this as a starting point, if we were to do lengthening cycles with equal distance here between the previous cycles, that would make this cycle take 1,004 days, which would mean another 340 days, which would put the bear market low in March of 2023. With the first chart we looked at using the bear market low as a starting point, It gave us 530 days as the expected bear market low. And with our current chart, it gave us 340 days to reach the next bear market low. And with both of those, it's looking at extended cycles that are extending by the same amount each cycle. If we were to do the same thing as the previous cycle, then that would give the bear market low in 226 days, which would be sometime around the end of October. The first chart we looked at was 250 days. If we did the same thing as the previous cycle, this current one, 226 days. So they are quite similar, and we would expect that if we are doing similar 4-year cycles. We do see a variance on the extended cycle dates, so that is interesting. And again, we see a similar thing here. We were ahead of the previous cycle in red here. We see the blue line did get above the red line. We had that big crash from the China mining ban, went below the previous cycle's percentage gains. We were traveling quite similar, but we did have that blow off top at the end of the previous cycle. And again, we had that more rounded double top here. And it does look quite similar when looking at the bull market peak, which happened about the same number of days after the halfening as the previous cycle. So that was on the log scale. So again, we'll look on the linear scale and get rid of that first cycle. And we can see, obviously, we missed that blow off top finish here. And again, perhaps 30k is our base here, similar to when around 9 or 10k, I believe it was the base in that 2018 bear market. So now we're going to compare the 3 cycles again, but we're going to be using the halfening date as the start point and the next halfening date as the end point. Basically, we're measuring how long between halfening dates, if that is getting shorter or longer. And again, just showing that side by side. This is cycle 1, cycle 2 in the middle, our current cycle on the right, and the white line's the halfening dates. So let's compare the 3 now, looking at the first cycle in yellow. If you would have bought the first halfening date and sold at the next halfening date, that would have been a 5,120% profit. Looking at the second cycle, it would have been a 1,250% profit. And with our current cycle, we're currently up 330%. Looking at the time lengths between halfenings, between halfening 1 and halfening 2 was 1,320 days. Between halfening 2 and halfening 3 in red here was 1,400 days. And currently we're 664 days into this cycle. We do see approximately 4 years, which is 1,460 days. We did see it lengthened slightly, only by about 80 days here. So we do expect the next halfening in 2024. And that could be somewhere between another 750 to 800 days. And 750 days is just over 2 years. So that would put us somewhere around May of 2024. So now we're going to compare the 3 cycles again, but looking at the percentage losses from the bull market peaks to the bear market lows. And we're going to do it in 2 ways here. We're going to use the 69k peak here and compare the 3, but we're also going to use the 65k peak here. And the reason for that is when looking at a lot of the indicators, it does seem to indicate that this was actually the peak. Even though we did do a slightly higher high, the indicators had a lot more weakness on this run up. And if you were just looking at the indicators, you would say this was the peak. And also the amount of excitement with people in Bitcoin and buying Bitcoin here was much greater than during this second peak. So it is a bit deceiving. We did technically make a higher high, so this is the peak, but we're going to compare both of them, and perhaps that will give us a better idea as to where we might expect the bottom of the bear market if we are in a bear market. And I do believe Benjamin Cowan has also been talking about that, and a few others, that a lot of signs do point to this being the peak, even though it wasn't the price peak. And I know a lot of people watch his channel from my subscribers, so we are going to look at both of these peaks as the starting date. So here we are, all three cycles together, with the starting date as the bull market peak, looking at the losses towards the bear market lows. So we have the first cycle in yellow here, and we see that it dropped 84% from its peak. The second cycle in red here dropped 83%, so pretty much the same percentage drop. And our current cycle is down 42% currently. The first cycle took 410 days in the bear market, the second cycle 360 days, and our current cycle, if 69k was the peak, has been in a bear market for 113 days. So this shows something a bit different on the way down. It shows shortening bear markets. This was around a 50-day difference, and if we were expecting another 50-day reduction here, then that would mean a 310-day bear market with our current cycle, which would be another 197 days away. And that would be about 6.5 months, putting us around the start of October. If we are to do a similar thing to the previous cycle, then we are around 247 days away from the bear market low, and that would put us somewhere in mid-November. Looking at where we are currently, being 42% down, we haven't dropped as much as the previous bear markets. And as we said earlier, we didn't have that blow off top, so perhaps our drop won't be as large. And currently we are actually above the previous bear market drops at the same point in time. But obviously there's a lot more to play out here if this is the model that's correct. So what about if we use that 65k peak back in April of last year instead of the 69k peak? Will we get something that looks really different here? This was the 65k peak here. We had that 50% drop down to 30k, and then we bounced and made a higher high at 69k, dropped back down to 35k. So if this were the case, it does look extremely different to the other cycles here, showing us being 40% down, while the other cycles were 70% down from their peak at the same number of days after that bull market peak. And if we were to do the same thing as the previous cycle, that would give us only another 32 days before reaching the bear market bottom, which would be in mid-April. When looking at it this way, it does make me tend to believe that the first model was right, and we do have to use that 69k as the peak, even though the technicals favor 65k as the peak in April. But still, I do believe that this model seems more accurate with that 69k peak starting date, and we are in the early days of the bear market, again reaching its low around possibly mid-November. And just going back to this model, what would change my mind is if we did have one of these big drops we see at the end of the bear market here. In the previous cycle in red, we had that 50% drop here to end the bear market. We also saw quite a big drop at the end of the first cycle. So if we were to say drop from 40k to 20k quite quickly, this drop did happen quite quickly in about 30 days. So if we did drop from say 40k to 20k in a 30-day period, then I would say that was the bottom of the bear market, and perhaps this model is correct. So what can I conclude from all of these charts? I do think the 4-year cycle model is the one that I'm going with, and I do think we're playing out a similar thing to the previous cycle here. We did top around a similar time, looking at it from the bear market low. Also looking at it from the halfening as the starting date, we also topped out around the same number of days as the previous cycle, and we do seem to be following a similar trajectory with the current 50% drop, which I think is the start of the bear market. And when extrapolating our current cycle onto our previous cycle, looking at it as the previous bear market low as the starting date, it predicts that the bottom of the bear market of this cycle will be in 250 days. When looking at it from the halfening as the start, it predicts it in 226 days. And when measuring it from the bull market peak at 69k, it predicts 247 days until the bottom of the bear market. So 250 days, 226 days, and 247 days. And there is some confluence between those three. And again, that would put the bottom of the bear market around mid-November. So I'm sticking to that 4-year cycle as what I believe is happening. But I am also thinking that we're not going to have the traditional 83, 84% drop like the last two cycles, as we didn't have that blow off top. So we're not going to have as a dramatic drop from the peak. I do think we're possibly going to go as low as 20,000, but I am expecting maybe 25,000 as the bottom. Perhaps we wick down to 20, but the candle bodies on a weekly time scale stay above 25,000. And if that were to happen, that would mean we would drop approximately 65% if we do a bottom out at 25,000. And that would fit our current model here, as we are above the previous two cycle percentage drops at the same point in time. So between 20 and 25k around November of this year. But we'll follow this along, and it will be interesting to look at these charts as this does play out. What would change my mind as to lengthening cycles? Well, obviously a new all-time high would definitely change my mind on that. But even trading above 50k and holding that for at least a month or so, that would give me a bit more confidence that we're going to push higher and perhaps test those all-time highs. And then perhaps we could look back at the first cycle here and this consolidation and the lengthening cycles theory. And again, if that were true and we were to apply the same distance between previous cycle peaks, that would give a projected peak date of this extended cycle as November of next year. But time will tell. And I think that's about all. This was a pretty long video, but I hope you enjoyed that cycle analysis and something different. Thanks for watching. I'm Bitcoin Mamo. I'll see you next time. Bye.